We're all being hit with a lot of economic news. How do we make sense of all of it? Let's see what this week's economic numbers are telling us. The week's most anticipated economic metric turned out to be its most disappointing. The Labor Department reported on Wednesday that the Consumer Price Index, CPI, accelerated last month, highlighting ongoing challenges in controlling inflation and dimming prospects for near-term rate cuts. According to the data, headline CPI rose 3% annually in January, a tenth of a point faster than in December, and the highest rate since last June. Core CPI, which excludes food and energy prices, increased 3.3% year over year, also a tenth of a point higher than December and above economists' projections. Food and shelter costs drove inflation. Food prices rose 0.4%, including a 15.2% spike in egg prices due to the bird flu outbreak. Shelter costs also climbed 0.4%, contributing about 30% of the overall CPI increase. Many analysts believe rate cuts are unlikely soon. Josh Jammer, investment strategy analyst at ClearBridge Investments, stated, "The wait-and-see Fed is going to be waiting longer than anticipated after a red-hot January CPI inflation report. This report puts the final nail in the coffin for the rate cut cycle, which we believe is over." Federal Reserve Chair Jerome Powell addressed monetary policy during his semi-annual monetary policy report to Congress, delivering prepared remarks to both the Senate Banking Committee and the House Financial Services Committee. With our policy stance now significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. When questioned about the impact of tariffs, Powell said, "We can't know what the effect on the economy is until we actually know what policies are enacted. We will then try to make an intelligent judgment about the overall effect on the economy of those and conduct our policy accordingly." Market expectations currently forecast only one 25 basis point rate cut for the rest of the year. On Tuesday, the National Federation of Independent Business, NFIB, reported a decline in small business optimism. The Small Business Optimism Index fell 2.3 points in January to 102.8, down from December's six-year high of 105.1. While still above the long-term average of 98, the Uncertainty Index rose sharply, climbing 14 points to its third highest reading ever. Analysts attribute recent optimism to expectations around a pro-business presidential administration, but note growing concerns about the economic impact of policy measures such as increased tariffs. The U.S. budget deficit is on track to exceed last year's $1.8 trillion total. The deficit grew by $129 billion last month, pushing the fourth-month total for fiscal 2025 to $840 billion, 58% higher than the same period last year. Key drivers of the deficit include increased spending on Social Security, Medicare, and debt interest. Receipts, primarily from tax revenue, reached $1.6 trillion, up 1% year over year, while outlays hit $2.43 trillion, up 15%. The deficit is currently projected to surpass $2.5 trillion by year-end, potentially marking the third largest deficit in U.S. history. Well, that's it for now. We can all see that inflation and deficit spending is still a problem, regardless of all the news out there. So make sure to stay tuned next week to see how the numbers might be affecting you. This is Devlin Steele for Augusta Precious Metals, signing out.